Good morning and welcome, everyone. My name is Marina Muñoz, Regional Manager for the Urban Housing Practitioners Hub for Latin America and the Caribbean. Before we begin, I would like to share that this session offers simultaneous interpretation to Spanish. Please go to the bottom part of your window. You can click the 3 points and then you can access the interpretation. It is a pleasure to open this webinar, Housing Capital, How to Expand Financial Accessibility, and to be joined by such a diverse group of policymakers, sector professionals, and entrepreneurs. This session is part of the series Housing 2.0, New Perspectives for Latin America and the Caribbean, a set of 5 virtual dialogues designed to explore how housing systems must evolve to respond to the region's new social, economic, and demographic realities. Through these exchanges, we aim to highlight innovative approaches, global insights, and practical lessons that can inform the design and more flexible, inclusive, and resilient housing strategies. This series is a result of a collaboration of the Urban Housing Practitioners Hub, the Inter-American Development Bank, the IDB Invest, as well as Urban Transitions, the Global Covenant of Mayors for Climate and Energy, for their collaboration and commitment in making this series possible. Please also remember to share your thoughts and questions through the Q&A button all along the webinar. You can find it also in the bottom part of your Zoom window. Now, to moderate the session, I have the pleasure to present Gabriela Mera, Director of Andean Region Financial Institutions Sector from the IDB Invest. Welcome, Gabriela, and the floor is yours.
Thank you, Marina. Good morning, everyone, and thank you for joining us today. I would like to begin by also thanking our co-organizer, the Urban Housing Practitioners Hub, as well as our partners at IDB Invest, Urban Transitions, and the Global Covenant of Mayors of Climate and Energy, for their collaboration in this and making this possible. Today's discussions focus on a central dimension of the housing challenge that is often overlooked: capital. Housing deficits across Latin America and the Caribbean are not only the result of insufficient supply or weak planning system. They are also deeply linked to how financial systems operate, how capital is structured and how risk is assessed, and ultimately, who can access financing and who cannot. Traditional housing financing models often leave large segments of the population outside formal markets, particularly informal workers, younger households, and lower income families. At the same time, we are witnessing the emergence of new financial architectures, impact funds, blended finance structures, fintech, infrastructure, community-based financial models, and artificial intelligence-enabled credit systems. The questions we explore today is therefore both practitioner and strategic. How can with these financial models expand access to housing while maintaining affordability, financial stability, and social impact? To frame today's conversation, it is helpful to begin with 3 structural dynamics that are reshaping housing finance globally and across Latin America and the Caribbean. First, financial exclusion remains one of the most persistent barriers to housing access. Even in countries with relatively developed mortgage markets, millions of households remain outside formal credit system due to informality, insufficient collateral, or traditional credit assessment models that fail to capture real repayment capacity. Second, the scale of investment required to close housing gaps far exceeds public sector capacity alone. Expanding access to adequate housing requires mobilizing new resources of capital from institutional investors, impact funds, and private markets, while designing financial structures capable of aligning financial returns with social outcomes. Third, financial technologies are transforming how housing finance ecosystems operate. Digital platforms, fintech solutions, embedded finance, and artificial intelligence are redefining how risk is evaluated, how financial products are delivered, and how previously excluded households may enter into formal systems. These developments open new possibilities, but they also raise critical questions about regulations, governance, consumer protection, and longer-term affordability. And this is precisely the intersections we will explore in today's session. Having said that, the objective of this webinar is to examine how new financial architectures can expand access to housing finance in Latin America and the Caribbean. We will explore how financial innovation, including impact, blended finance, fintech, infrastructure, and artificial intelligence-enabled credit assessment can help dismantle barriers that prevent households from accessing adequate housing. Equally important, we will discuss the institutional and regulatory conditions required to ensure that these innovations contribute not only to financial expansion, but also to equity, resilience, and long-term affordability. Our conversation today will unfold in three parts. We will begin with a keynote presentation that provides a conceptual overview of how impact capital and blended finance are reshaping housing finance globally, one study case from India. Then we will move to a panel session, bringing together perspective from international policy, fintech innovation, and impact practice. Finally, we will conclude with one case study illustrating how housing finance ecosystems operate in the African continent. To begin our discussion, it's my pleasure to introduce Sebastián Huelisco, Managing Partner at New Ventures. Sebastián will help us frame the evolving role of impact capital and blended finance in housing markets, and how housing and neighborhood improvement is increasingly being positioned as scalable impact investment cases in the asset class. His presentation will explore how innovative financial structures can unlock institutional capital while safeguarding affordability and social objectives. Sebastián's perspective is particularly relevant as policymakers and financial institutions seek to reconcile two critical goals. First, mobilizing capital at scale while ensuring the housing and neighborhoods remain accessible and inclusive. Sebastián, welcome, and the floor is yours.
Hello, everyone. Thank you, Gabriela. Can you hear me well?
Yes.
Good. No, thank you so much to you, to the group, to UHPH, Marina, and everyone in the team for this kind invitation. As you noticed from Gabriela, pronouncing my surname is very, very difficult. That's why everyone, anywhere, in any part of the world, calls me Welly. Those are the first four characters of my surname. So you're all welcome to call me Welly from now on. Look, Gabriela, what you introduced is right, but I don't have the golden grail of a definitive answer. No one has. It's something in the making, and we'll try today to speak about the challenge we have more than silver bullets. We don't have any silver bullets, and finance is just finance. So that's the overall caveat. Financial solutions are a means to an end. So let me try, invited by Marina. I will pull out some slides, if that's okay. That typically I don't do, but I did it because Marina is my friend. So she said, use slides. And I said, yes, Marina, I will do it for you. These are actually part of a presentation for the IDV group. Last year, I had the privilege of working with friends at the Housing and Urban Development Division on innovative financial tools to support urban development, including neighborhood and housing improvement. All of those proceedings are captured in a discovery paper for the division that's now online, and you can check it out in Spanish and in English. So part of what I will show today comes directly from that work, which is basically a conversation opener, a discovery paper, and let's see, hopefully it will be a bit of inspiration. So let me talk quickly through these materials. I won't touch on everything. I will try to be quick, and then we continue from there. So before jumping into finance, I'm an economist. I'm an economist specialized in development. I care about people and I care about natural systems. That's always the thread in my career. And finance came later on in my life. I don't know, like 15 years ago. And finance is just that. It's a means. It's a tool. The underlying most important message is, as a development economist, I think there's evidence that housing and habitat, adequate housing and habitat, are enablers of multidimensional climate positive development. And the opposite is also true. Lack of adequate housing and habitat are drivers of many undesirable outcomes in terms of health, education, labor market development, and caring for the environment and climate. So the most important thing is the underlying social, environmental, and climate-related issue we are facing. Second, good news. Bad news, good news, we don't know. We estimated in that research that the investment gap to face the sectoral deficit is $1.4 trillion only in Latin America. I will talk a bit more about that. And that we have been facing over the past decades, or maybe forever, limitations and barriers that are not being amicable for private sector participation in systemic solutions. The relatively good news is that there are a number of financial innovations coming out of the impact investment and the impact finance world that where I've been specializing over the past 10, 15 years, that we think humbly that can be part of the solution. So that's the flow of what I will try to say today. So these numbers, folks here who are experts in the sector will know it, but it's always good to look at this. 55 million deficit of housing units. Contrary to what people think, most of that is qualitative deficit. So 15 million buildings we are lacking. 40 million households face qualitative deficits, and that includes more than 110 million people living in informal settlements in Latin America. A massive tragedy. 1 out of 6 Latin Americans live in informal neighborhoods with no access to electricity, water, sanitation, and with no land titles of the land they inhabit. Now, the thing is, as I said, we estimated the gap in $1.4 trillion. $1 trillion, like the Americans say, like the folks in the USA, millions of millions. It's a number that is hard to intellectualize. It's very, very big. And that is roughly 20% of the GDP in Latin America. But the governments invest on average, every year, roughly 0.8% of their budgets on things that have to do with housing and habitat, meaning public finance, public resources, fiscal resources alone will never, ever be enough. So I think first we need to wake up to that fact. Either we innovate in scaling private capital participation, in fostering these solutions, or we say goodbye, and this issue keeps compounding and compounding and compounding with very grave consequences for the environment and also for social cohesion across all of our societies. I am speaking today from Buenos Aires. If you are in Lima, in Bogota, in Mexico City, in Sao Paulo, you see exactly the same that I see. A mounting level of social segregation manifested territorially in the way we organize our cities. Luxury on the one hand, informality on the other hand, growing, and that creating many, many issues for life in the society. But there's also a particular region, as you said, Gabriel, in the beginning, more than 50% of labor informality. We'll come back to this in Latin America. And as you know, also, construction and maintaining of buildings, it's a big driver of global emissions of carbon. Now, what are the cons, let's say, or why isn't private capital engaging more in this agenda? And we are depending on the very small public budgets, including the funding for the multilaterals, that it's a form of financing public spending, but in the end, traditional investment from the multilaterals is public spending in the end. Never mind, it comes from an operation of credit with the IDB or the World Bank or CAF. Now, yeah, there is a relative lack of track record of blended solutions in anti-risking mechanisms in housing and habitat. But that evidence base is growing, and it's certainly growing in other sectors, and there is no reason why we can't adopt it here in housing and habitat. Now we are lacking, it's evolving, but still not mainstream, financial products tailored to the inclusion of vulnerable workers, informal households. The requirements to enter any of the credit schemes is still quite traditional, with the mindset of a traditional bank. And as I showed, more than 50% of workers in Latin America have informal income, informal livelihoods. So the system is not attuned to the reality of the workers. The traditional banking institutions don't have a way to assess their risk. The willingness to pay, the ability to pay for solutions is there. It's increasingly getting there through some fintechs that are innovating in the way they score, but it's not mainstream yet. And this is a bit more nerdy when we talk about impact investment, when we talk about market and friendly impact frameworks. Still today, what we see is prevalence of impact assessments that are a bit more academic rather than working on impact frameworks that allows us to assess the outcomes of our investments in real time, which is what we impact investors want to see. Not only an academic evaluation 5 years after a program with randomized controlled trials, which is always amazing to have, but it's not attuned to making decisions in terms of a capital allocation in real time. Now, this is what I won't be able to touch in full here in this paper. If you want to peruse it, I hope the team is putting the link there in the chat. We talk about a number of innovations. I will go through these very quickly just to give you a snapshot. So, for example, look at the growth of the global, of the green, sustainable, social, and sustainability-linked bonds in the world. It's one of the assets growing more profoundly. Investors are looking for debt instruments issued by sovereigns or issued by corporates, by private investors that are linking their proceedings to verifiable social outcomes. Housing, for what I say in the beginning with my development economist hat, has a great promise in this. The good news is that the region has frameworks to issue these kind of bonds and taxonomies pretty much in all the countries. There is no reason why we can't build in leading examples, for example, as Ecuador's first sovereign social bond to finance the program Casa para Todos, a fascinating case that I invite folks to revise. And I think that's showing the way. Now, the untapped potential in Latin America for more issuance of social, sustainable, and sustainability-linked debt tied to housing is enormous. And there is no reason why we don't have the elements to untap on that potential. Of course, catalytic and blended finance, but let me choose from a number of things. Here, outcomes-based financing schemes that tie financial performance to the to real outcomes, verifiable, pre-agreed outcomes. Emerging institutions are working on these schemes in Latin America. No reason why, again, we cannot fine-tune that in a theory of change when you build adequate housing or when you work on qualitative deficit. The theory of change is very strong. The link between the investment and verifiable outcomes, I insist, in terms of the built environment, of course, but also in terms of health, security, social cohesion, education of the young people in the household. All of that is mega proved by the evidence, and these are the kind of things that the impact investors wants to see. There is a very robust impact story to be told behind the impact investment, and these outcomes-based financing schemes link financial returns to verifiable social and environmental performance. And there are many traditional elements deployed innovatively, let's say. So I just want to finish talking about, for example, this case. I have the privilege of being Vice Minister of Social Development here in my country, in Argentina. And I was in charge of the country's first effort to make a comprehensive census of slums and informal settlements in the country, create a program to urbanize 5 million people living in slums, a bit more than 10% of the population. And we proposed and we created by law a special purpose vehicle, a trust, here we say a fideicomiso financiero, to finance those. But the thesis was the same. If the country continued to only invest fiscal resources, forget it, we are dead. The deficit to urbanize these slums, the gap was of $26 billion, and in a wonderful year, the state would invest roughly $50 to $70 million, meaning that the vegetative growth of the need was way higher than the ability of the state alone to invest. So either we create a public-private blended finance vehicle where you tap into resources from the multilaterals, but if you don't connect these schemes, for example, with the capital markets, it's roughly impossible to even think about tackling the issue at scale. And what we're saying is that the ability to repay is there. From provinces, from municipalities, from households themselves, and from using elements, for example, of land value capture, that they are there, they exist in policy, but not many policy leaders, especially the municipal scale, are deploying them efficiently. So there are many technicalities here, but the thing is that if we don't bring extra resources to the fiscal ones, and if we don't find new repayment mechanisms that make this sustainable, it's very difficult. The multilaterals have a massive role to play in helping boost these schemes. Lots of more materials. We're talking about guarantees. And I will park it there because I think I'm on time. You're always welcome to look at the cases. That discovery paper we did for the bank is filled with case studies and with evidence and with links. It's a very expandable resource. What I mean is nothing of what I mentioned is the message is not copy and paste this, but there are elements in outcomes-based financings, in the use of blended finance, in the setup of special purpose vehicles to fund this, in the creative use of guarantees by multilaterals, by banks. It's multi-stakeholder, sometimes it's complex, but the moment you come back to the financing gap of $1.4 trillion and you wake up to the fact that with only fiscal money, we will never get there, either you innovate in finance or you say goodbye to that aspiration. And what will happen is that we will continue to inhabit a region that is increasingly more unequal, increasingly more unstable, difficult to inhabit, uncomfortable to inhabit, impossible to govern for the public sector. And I don't want to live in that region. I want to stay here. I want to have a more friendly society, more climate friendly. Everyone who is here, I bet we are wanting the same. So the call is for all of us. There are many specific messages here to civil society, to housing experts, to impact investors, to government, to multilaterals. I won't go through those, but as you can see, it's a multi-stakeholder effort where we all have to shift a 2.0 version of our traditional approaches and to challenge and to work in an interdisciplinary way to start connecting capital with purpose. And I insist the promise in the housing and habitat sector is enormous. So thank you, Gabriela, and thank you to UHPH. Looking forward to the rest of the discussion.
Thank you very much, Sebastian, for helping us frame the broader financial architecture that is emerging around housing and neighborhood improvement. I would like to ask a brief question before we move to the case study segment. You already mentioned, of course, the market failure that we have in the housing, and it's all over across the Latin America and the Caribbean. But how is the global impact investment ecosystem redefining housing as an investable asset without diluting its social purpose, Sebastian?
Look, Gabriela, that's a great point. And sadly, I will say the following. I've been affiliated with a global organization called GSG Impact. It's a global market builder on impact investment. I've been working with them for 12 years. 3 or 4 years back, we produced a piece of report knowledge innovation for them called Informal Settlements No Longer Invisible. And there was a provocation in the title, no longer invisible to mainstream investors on what someone would call the global north. There are more than 1 billion people living in slums. The same number I said, 113 million in Latin America, 1 billion people around the world. Today, I have the easy and maybe a bit unfair answer to your question is that mainstream impact investment today is not looking at housing the same way we from the ground up in Latin America, in Southeast Asia, in Africa are experiencing. Housing and habitat are an issue of impact investment, but probably they are more attuned to the problems they have in the UK, in the US, perhaps with affordability of housing, and that's very good. It's very different to the issues of inadequate housing, that share of qualitative deficit we have here. So today, the way we face it south of the equator, the issue, I don't see mainstream impact investment markets reacting to that adequately. The investment gap we estimated back then for GSG, for slum urbanization globally, was of $6.6 trillion. So what we are saying is invisible to us, the issue, it's not, because we walk out the door and we coexist with that. And we are seeing the consequences of territorial segregation. Now, the mainstream investors in the US, in the UK, in Germany, in Japan, they don't coexist with this. So it's invisible to them in a way. To us, what is invisible is the financial innovation. So the call is to marry the two. So the rough answer is sadly, the way we see it today, housing and habitat in these terms is still not a mainstream area for impact investment that continues to be concentrated on a lot of green energy, sustainable infrastructure, climate continues to dominate, and perhaps on the social, I would say education, labor market development, a bit of health, but there is a long way to go also globally from the north to the south and from the innovation that we bring in the south to the north. So I think this discussion at the global level is not brilliantly developed, but we have to keep working on that.
Thank you, Sebastian. Thank you very much. So then we are going to move to our first case study, take us to India and focuses on the role of financial architecture in expanding housing finance accessibility. We are honored to welcome Sanjay Shukla, Managing Director of the National Housing Bank, the apex institution responsible for regulating and strengthening India's housing finance ecosystem. The National Housing Bank has been advancing a systematic approach to housing finance, providing liquidity and refinancing to housing finance companies, strengthening regulatory coordination and enabling new credit assessment models that expand access for underserved households. Mr. Shukla will share how institutional financial architecture can mobilize capital, reduce risk across the ecosystem, and support the large-scale expansion of inclusive housing finance. Mr. Shukla, the floor is yours. Welcome.
Thank you, Vera, and hello, everybody. And thank you for advancing my time because it's evening in India, late evening. So I requested you, and thanks for accommodating my request. So quickly, I'll take you through my presentation. But before that, I would like to share that in India, when we got post-independence, we had three objectives for every individual: bread, clothing, and the housing. All the governments in the since independence have focused on this, but the current government has come up with a very innovative scheme, which is called for the Prime Minister Housing Scheme, which I will take you to through that, but little later. So housing, as we all know, is a basic need, and the SDG also points make cities and human centered inclusive, safe, and resilient and sustainable. And in India, housing is viewed as the safest asset, providing better inflation-adjusted return that a traditional saving instrument gives in India. And the property prices still are rising at the rate of 3 to 4% per year, and in certain cities it is 5% also. And rapid urbanization, as we are the second largest population, having the second largest population in the world. Probably, I don't know, they say that it might overtake China or has overtaken China. But that has also pushed us to make more and more, policies in order to have everyone should have a roof over their head. And projected growth in urbanization also forced us to transition from traditional build to live model to finance-led mass development, which we have witnessed in the last 7, 8 years. The missing critical link of finance needs to be supplemented with AI-enabled tech providing alternate credit scoring model. We have done a lot of work in the last 6 years, and we have come up with very innovative tools to deliver the product in less than 72 hours because, in housing finance, it requires a lot of study of technical, legal, and other aspects of the lending. And innovation in the financial should lie at the core. As we said, we need to look at the housing finance for all. And the current government, the slogan is housing for all. So what we do that India, given the size of population, there are three traditional lender. One is banks, which lend for housing. There is specialized housing finance company which are regulated, supervised, and under our banner. We have about 94 housing finance companies. So then, but we were not able to reach to the tier 3, tier 4 city of the India. Then we started leveraging on the microfinance institutions. So we started a co-lending model with the microfinance. We explored innovative and new financing instruments like micro mortgages and like flexible payment option, not conventional EMI, because largely the rural economy and semi-urban economy is dependent on agriculture or the seasonal income. So there we came up with the quarterly payment or the half-yearly payment, and lending rooted through self-help group. We had in India, the microfinancing and self-help group where, 20, 30 people, they form a group and they give the guarantee for each other, and can be a significant move in addressing the funding gap in this segment. And limited access of the marginals over to institutional credit, because everybody wants a decent credit score before lending. The traditional bankers, the old banks, and government banks, they all. But that gap was bridged by microfinance and HFCs and housing finance co-lending model. Here, in fact, we have today 74% of our customers are new to credit. And new to credit, they don't have credit history, and even at times, they don't have even formal income, documented income. Like it's more like any developing economy where the large population is still not having access to the formal lending. And from the policy perspective, the lesser risk weight, like for any lending institution, the risk weight which is to be assigned for the purpose of credit adequacy ratio also has been reduced, which has made the loan provided to affordable segment, very attractive for the lenders. And in line with the underwriting practices for informal segment, for the rural credit score, a separate credit model can be developed for EWS, which is economic weaker section, and lower income group who are not having access to institutional credit. Cash flows based underwriting templates, which have been developed for the informal segment in India, which can be taken from here. The blended finance or the blended concessional finance combines the finance from the donors to third party, which we had very little percentage of our blended concessional finance have a donor, but the rest is commercial finance and a lot of subsidy coming from DFI. DFI is a financial institution like us, and we come up, there is a budget allocation in the government, which comes to us at a much cheaper rate, and we blend it with our normal lending and provide the funds to the housing finance companies and banks to give it to affordable segment with the onward lending cap. Because today in India, typically the interest rate for premium segment is around 8 to 8.5%, whereas for affordable segment, it comes to 12.5%. But if you go to microfinance companies and if you go, originate mortgage through them, it goes to as high as 17, 18%. So in order to stop these companies charging a prohibitive rate of interest, because as in India, the average delinquency and net NPA in mortgage is around close to 2%, which is a very safe asset class. And in affordable segment also, the net NPA is around 2.25%. So there we have, in order to put a onward lending cap, because we give money to the housing finance companies or the bank, and we put a onward lending cap of 400 to 450 basis point. And blended finance also helps risk return profile of the projects, attracting private and commercial finance to project and activities that help to achieve SDG in different sectors. So now housing finance landscape in India. India in 1986, the outstanding individual home loan were about close to 0.23 billion. And in 24-25, we are around 403 billion and CAGR of 21.8%. And Indian individual home loan to GDP has grown from 0.7% to 11.2%, and still we are way below from the developed economies. It should be around 18, 19%, but hopefully we should be there in the next 3-4 years time. And this has been the progress law. But you see that the more progress has come from 2014, from 7.9, it moved to 12%. The 4% growth has come in the last 8 years. The individual housing loan increased from 0.23 billion, as I mentioned earlier, and launched Housing for All mission, which was in 2015, also followed by various concession which was given by the government on this GST, which is taxation, and the RERA. We set up the Real Estate Regulatory Authority, because what had happened, especially in affordable segment and the lower income group segment, the builder used to start the project and they used to stall in between, and the segment was not in a position to afford a house as well as the pay rent for his current house. So the government has mandated with a defined time frame, the houses had to be delivered. National Housing Bank, we have 3 pillars. One is the supervision. We supervise all the housing finance company through a system of on-site inspection and surveillance mechanism. Financing, we provide low-cost, long-term liquidity housing finance institution through refinance. Our refinance typically ranges from 7 to 10 years period, and this money we raise through from the market. And since we are a sovereign institution, the rate which we originate is about 120 basis point lower than anybody else. And we keep a very little margin of 20-25 basis point. And we give it for onward lending. Plus, we have money from the government through budget allocation, which comes to us at 4%. And then when we blend it and give it for onward lending, which helps us in getting the onward lending cap with 550 basis points. So end customer gets money at around 9.5-10%, which is a much lower rate given that segment's vulnerability to delinquency. The government has established Affordable Housing Fund, and Affordable Housing Fund, which we manage, the primary purpose is to provide low-cost refinance through cheaper home loans, which may be offered to EWS and LIG segment. And the money in the AHF, which is Affordable Housing Fund, comes from priority sector shortfall. In India, we have a allocation that every bank has to lend about 40% of its loan book in priority sector. If there is a shortfall, that money they have to deposit with the Reserve Bank of India or with us as a shortfall penalty. To ensure the better benefit reaches to poor, there is an on-lending cap, as I mentioned, of 550 basis point, 450, depending on the type of lending. And on 31st June, a cumulative amount of 6.59 billion has been disbursed for AHF, which is a big number. And now coming to the Pradhan Mantri Awas Yojana, which I was talking, it was launched in 2015, launched with the target of providing 11.2 million houses. We had the 8 components. One is in situ redevelopment, because in big cities in India, you have this slum, which we decided to redevelop and giving them a house at a much concessional rate. Second was the housing through credit-linked subsidy scheme, where you take a loan, government gives you subsidy, and subsidy was about 20% of your housing, the cost of house, the loan which you take from the lending institution. Then we had started affordable housing in partnership, building the project. Government gave the land to the private developer, and then they started constructing on that, and government gave also subsidy. Then we have interest subsidy scheme in 2, Pradhan Mantri Awas Yojana 2, which was, then we started another product called rental housing, affordable rental housing. Oh, sorry, I missed my screen. Yeah, sorry. Affordable rental housing, because we also, especially the migrant worker and laborers, they stay closer to the town. So for that, this scheme has been started in the Pradhan Mantri Awas Yojana 2, which is the scheme 2, which was launched 1.5 years back. But in the PMAY 2, which was just launched, we have reduced the subsidy amount, because in the PMAY 1, which was between 14 to 19, which we had 20%. Now we have reduced, because now some population got benefited through PMAY 1. So we decided to reduce it by a little margin of 10%. The achievement under PMAY U and 2, 12.2 million houses have been sanctioned, 11.4 million have been grounded. 9.7 million houses completed, and we had committed $22.25 billion central assistance, and central assistance we released 19.18. And NHB as a central nodal agency disbursed 5.3 billion under PMAY, benefiting 2.1 million household, which was the targeted number under PMAY 1. PMAY 1 aims to provide houses with the basic amenities to all households and those living in depopulated houses, rural area by 2029. By 2029, everyone will have a roof above his head. That's a scheme, and with that intent, it was launched. The scheme intends to achieve the objective of housing for all, and this also empowers beneficiaries to build quality home using the local material, appropriate design, and trained rural measures. Initial target of 29.5 million houses by 23-24 to meet growing stock, an additional 20 million houses to be completed by March 29. At present, we have done close to 30 million houses. And from the role of NHB, when it comes to, because it's a very NHB as an organization, we have supervisor role, lender role, and then the market development role also. A refinance mechanism, we give money to all the lenders at a very concessional rate. Now, another thing which we came up with this, because when we spoke to the lenders, then they were a little skeptical about the risk which they were carrying for the urban EWS or LIG segment. So we started giving them credit risk guarantee. Government also set up a fund for giving the guarantee up to the 70% of the outstanding loan. So that has also helped, that has boosted the confidence of the lender, and they started going and, taking more, and not the risk, I won't call it a risk, but they started disbursing money with some flexibility in the credit underwriting. Credit enhancement by providing credit guarantee to municipal bonds, with the municipal corporation, they raise money to provide affordable housing. Then we are setting up a national housing exchange where people who have multiple property or who have excess property, they can also move from, you can sell it on one platform, or, they can do a barter system. Coordinating the data aggregators to move from asset-based cash flow-based lending. And now, in this direct benefit transfer of subsidy to the account of the beneficiary. So this is what we have, and I hope I'm in time. Yeah. So thank you.
Thank you.
So I would like to, if you have any questions, it will be a pleasure to answer.
Thank you very much, Mr. Shukla, for sharing the overall strategy of the National Bank in supporting the expansion of affordable housing, particularly for low-income population. And it's very interesting to see how critical is the role of financial institutions in playing this type of filling out, the market failure in terms of lack of access to financing for housing. Thank you again, Mr. Shukla. And then in terms of, just respecting the time that we have, I'm going to move into the panel discussion.
Yeah. Thank you. Thank you. And thanks for inviting me.
Our panel today brings together three complementary perspectives on housing finance, international policy and regulation, financial technology, innovation, and impact investment practice. Together, these perspectives allow us to explore a central question: how can housing finance ecosystems evolve to expand access to capital while maintaining stability, accountability, and affordability? So let me introduce you to our distinguished panel. Our first panelist is Luis de Mello, Economic Director at the OECD. Luis will offer a global policy perspective drawing on trends in housing finance systems, capital markets, and regulatory frameworks across countries. His intervention will help us understand how governments and regulators can create enabling environmentals for financial innovation while safeguarding systematic stability and affordability. Welcome, Luis, and the floor is yours.
Thank you very much, Gabriela. Thanks for the invitation to join you, and thanks for your kind words of introduction. I will share my screen because I wanted to show you a few big numbers that we have in the OECD to try and contextualize the issue for countries beyond Latin America. Let's not forget we have 4 members of the OECD that are Latin American countries, but also some more diverse experiences elsewhere. I wanted, Gabriela, to start with this chart that all of you have seen before for other parts of the world, just to illustrate the challenge that we are facing, right? I mean, if you look at over the last 10 years, the increase in house prices in OECD countries, in some cases you have very high numbers. If you look at the countries on the left of the chart, house prices have doubled over a period of about 10 years. So it definitely imposes or creates an affordability challenge. Incomes have not risen by and large by those magnitudes. So what we are seeing essentially is that what is behind this phenomenon is a simple fact: is that supply of housing hasn't kept up with increasing demand. And demand has risen for a number of reasons. In many countries, it has to do with population growth. In others, it has to do with income growth, economies that are doing well in some cases. In other countries, the increase in demand or the strength of demand is policy-driven. Let me just give you an example. There are several countries in the OECD area that provide tax relief for interest payments on mortgages without at the same time taxing imputed rents. So that is a feature of the tax system, that is policy, that encourages demand at times where supply is not growing by the same amount. I just wanted to make this point to illustrate that there is a lot that is behind the affordability issue. That is policy driven as well. And supply, why is it not responding to increases in demand? For a number of reasons. Again, some of them are policy related. Land use regulations that may be overly restrictive. In some countries, labor shortages that are increasing the cost of construction and development. In other cases, it has to do with the physical nature of cities that cannot expand very easily. In other societies, demand for low density in urban areas that again pose a constraint on supply. Social preferences are also changing. Many countries where the population is aging fast, household sizes are changing. People are looking for different houses. They are looking for different features in houses that are better tailored to their needs. So all that is behind this. No? Let me show you another chart that is about how people feel about the issue. This is the result of a survey that we carry out in countries, and we ask the basic question: how do you see housing as a top policy challenge in your country? And you see in many cases that very large shares of the population think that housing is challenging. We heard from Sebastian and Sanjay about the specific issues of populations living in informal settlements. Let me just add to that the issue of energy poverty. In many OECD countries, there is big chunks of populations that cannot afford to keep their houses warm in the winter or fresh in the summer. So issues of housing quality is also very important. So housing finance is not so much, not only about development, not only so much about the green fields in the development area, but also about financing reconstruction and rehabilitation of the buildings and so on. Another indicator that we have for many OECD countries that reflect the issues of quality is overcrowding. In many countries, the housing stock is really overcrowded. So because people don't have access to alternative sources. So, informal settlement is one issue. There are other issues that denote poor quality of housing that call for finance options as well. Let me turn to finance. And I just wanted to show you how much has changed over time in terms of the supply of finance in many countries that we cover in our policy dialogue. Of course, when people in most countries, when they want to buy a house, they have to borrow for it. In OECD countries, mortgages remain the most common vehicle for buying a house, and countries differ tremendously in terms of the mortgage take-up rate, in terms of maturity structures, in terms of whether interest rates paid on loans is fixed or a variable rate, issues related to product structure and how they are regulated. But you can see from this chart that there has been a lot of growth of new mechanisms, new sources of finance that are diversifying, at least, that are helping to diversify funding sources in many OECD countries. Demand for mortgages has increased in the vast majority of OECD countries. That has been related to income growth, job market improvements, and so on. Over time, especially since the global financial crisis, balance sheets of households have improved as well, so that has facilitated access to housing finance. In many cases, financial innovation has allowed that to happen as well. And what is important also is that all that has happened with an improvement in most places of financial stability conditions. And a lot of it is policy driven. A lot of it has to do, especially since the global financial crisis, in countries that have been affected most adversely by the excessive leverage of households at the time, that have put in place regulatory systems that have basically, constrained over exposure of households to housing finance. We heard again before from Sebastian and Sanjay about certain specific features of housing finance and specific instruments in that case. Now, I just wanted to mention a few issues for OECD countries. Is that one is, and you can see from the chart on the right, is the increasing the size of investment vehicles like real estate investment trusts over the years. That has helped again to diversify sources of finance, especially for developers, beyond the traditional channels of bank lending, of marketable debt instruments, and so on. In some cases, instruments like exchange-traded investment funds have also allowed for a diversification of sources and lower costs of borrowing for developers. We heard a bit, and you mentioned it yourself, Gabriela, the issue of fintech. We are seeing in some countries that fintechs are becoming very active in certain segments of housing finance. They have allowed for some streamlining of mortgage origination. They have allowed for enhancing credit assessment, tools that are more agile to assess credit worthiness. Sometimes, the expansion of alternative lending channels as well. I mean, all that has helped to some extent to close financing gaps for future homeowners as well. In some cases in the OECD, we see the creation of revolving funds, so basically funds that channel part of the rents or the loan repayment income that they have into new affordable and social housing development. That is, there are some cases in the OECD that are interesting in that respect. Of course, they all differ in terms of their institutional setup, in terms of their funding and financing arrangements, issues around management and monitoring. So, but it's also a promising avenue to think about. And I wanted to mention two things before I conclude, Gabriela. One is that this is all well, but also we have to be mindful of risks related to the fact that we live in a world where uncertainty is very high. Uncertainty affects household balance sheets. It affects mortgage repayment performance in many cases. So we need to be attentive to that so that we don't go back to situations where the house price and construction cycle becomes a source of financial instability at the macro level as well. As I mentioned originally, issues about financial supervision, especially of the macroprudential type. Many countries are using more instruments such as caps on loan-to-value ratios or debt service to income indicators that can be used to increase the quality and reduce exposures to risk in that market segment. We've been discussing with many countries the need for lenders and for supervisors to ensure that underwriting standards are high, that there are more and more sophisticated mechanisms to assess risk, especially in countries where mortgage rates, interest rates are of the floating type, so exposures tend to be faster than in places where, for example, interest rates are fixed over relatively long periods of time. And I will conclude, Gabriela, with one final point. Housing finance is crucial in terms of determining accessibility to appropriate and quality housing. But if we increase the financing side of the equation only without making sure that supply becomes more responsive to demand signals, we're going to end up with essentially housing inflation rather than a bigger stock of housing. So there is a host of things that need to be done. Don't worry, I will not go through all the items in this chart, but I just wanted to show it to you to illustrate that beyond housing finance, there is so much more that policymakers can do on the tax front, on the regulatory front, on issues that have to do with urban planning and development, licensing and permitting, and so on, a host of policy areas that we know from experience and from international evidence that are associated with this responsiveness of supply to demand signals. If we can find that sweet spot where we boost the financing side, we make sure that there is more finance and finance at lower costs, along with the reforms that make supply more responsive, I think that's the way to go to make sure that housing becomes more affordable, and that if we go back to that original chart that I have, that you're not going to be confronted with situations where such big segments of our societies and our populations cannot afford to have a house either as a homeowner or as a renter. Perhaps in the debate, we'll come back to the issue of also developing the rental market segment, which is extremely important to address affordability issues. I'll stop here, Gabriela, but thanks for having me.
Thank you. Thank you, Luis. I just wanted to highlight that the work that OECD is doing in terms of housing finance, because it combines data, policy analysis, and practical reform guidelines, with a strong emphasis, as you already mentioned, Luis, in affordability and inclusion, financial stability and mortgage market resilience, and sustainable and climate-aligned housing investment, which is very interesting. At the end, we are going to move forward with the questions, but now I would like to welcome our second panelist, who is David Muñoz, founder and CEO of Creditu. Creditu is a fintech platform transforming access to housing finance in Latin America through alternative credit scoring and advanced data analytics, enabling mortgage and down payment lending to underserved populations. David will share how fintech infrastructure can expand financial inclusion while reducing transaction costs and improving risk assessment across the housing value chain. Please, David, go ahead. The floor is yours.
No, thank you very much for the invitation. To me, it's a pleasure to be speaking at this panel, at this webinar. So I think Marina is going to help me with the presentation. Cool, thank you. So my name is David Muñoz. I'm the co-founder and CEO of Creditu. So let's go to the next page, please. So let me start first with the problem that we are facing. So 1/3 of the families in Latin America do not have access to adequate housing, to a proper place to live. You go to the next one. And it is estimated that more than 40 million people do not have access to a proper place to live. And we all know that one of the main factors impacting this housing gap is the lack of the lack of financing tools to help these families. If you look at the left side, we can see that LATAM is one of the regions with the lowest mortgage penetration. When we measure it in terms of the GDP, we are still at a rate below 25%, which is super low when we compare it to developed countries, which range anywhere between 65 and even some countries exceeding the 100%. We also know as a fact that in Latin America, we get 3 times less access to credit. We also know that this market do not really have a lot of innovation. And with this, traditional banks pretty much completely dominate the market. They have like more than 90% of the market, which is super high when we compare it to more developed countries, which are at a range of 65%, because there are so many other alternative institutions, including fintech, that are also helping the market to growth. So with that, what we see is that there are segments of the population which do not really fit the model for a traditional bank. We don't know, maybe the financial system is not really prepared to serve them. We don't know if that's because of lack of trust, lack of data, if these segments are truly riskier than other segments, if this is lack of willingness to do it. It is maybe a problem that there are problems with the credit scoring, or it is a more robust problem with the capital allocation failure. Now you can go to next one. So in order to help solving this problem is that we created Creditu in 2017 with the main objective in mind to try to democratize the access to housing through different financing solutions. So since we created the company in Chile, we have expanded to Brazil and to Peru. I'm super proud to say that we have been able to issue more than $900 million in loans, mortgage loan, and some other home-related loans. We have helped more than 14,000 families to reach their dream. And all of this with a special focus on impact. More than 90% of our clients received some type of subsidy from the government. We also have a gender focus. In our portfolio, we have like 55% women, which is super high compared to traditional banks, which are the range of 35%. We also have a strong focus on immigrant families. 10% of our clients are immigrants, which is also super high compared to traditional banks. And we are also helping the next generation of people to reach their dream. 60% of our clients, we consider them as the young population. Okay, go to the next one. So when we first started the company, we thought that there was kind of a lack of trust, how we can truly understand and adequate the models for segments that are typically seen as riskier. So that's why we say, okay, we need to be better, we need to be able to collect the data, but we need to be able to transform how the credit scoring models work. So now, we created this platform. A client can go to see an apartment, they scan a QR code, we access several sources of information, more than 15, then we run machine learning models to have an idea and to have a first profile of each one of the clients and to truly understand what's the best financing solution for that family in that specific moment. So that has allowed us to evaluate the client in just a few seconds, which is super good compared to traditional banks that sometimes they take anywhere between 3 to 6 weeks to evaluate. With this type of models, we are also reducing the operating costs that at the end of the day are translated into our customer, and that has allows us to administer today more than $600 million in loans. Can go to the next one, please. So here, just some of the products that we have calibrated, developed. So the first one is the typical one, which is the mortgage loan. So what are some of our advantages compared to traditional banks? As I said, first, the speed. then we are much more flexible compared to traditional banks. Why? Because we have prepared our own models, not just based on 3 to 4 to 5 parameters, but in more advanced models. And within this group, I'm proud to say that more than 98% of our clients received some types of subsidy from the government. But then we started to realize that even though some segments were able to access a traditional mortgage loan, some of them didn't have enough savings for the down payment. And that was being a huge problem in Chile, Peru, and Brazil. Just for you to have an idea, to get a loan in Chile, you will need to have 20% of the value of the property. So down payment 20%. In Peru, this number ranged anywhere between 10 to 20%. And in Brazil, for Caixa, which is the main bank for low income people, they ask for a 30%. So we see, okay, we have a need, which is super clear. So we created this down payment product, which is basically a loan that covers like between 10 to 20% of the value of the property and up to 5 years. And that's unlocking the families to have access to their houses. And with this product, we have been accelerating the access to houses in about 6 years. And that's saving each one of the families anywhere between $30,000 to $40,000. Since we created this product 3 years ago, we have originated $30 million, helping more than 4,000 families. And the special thing is that with a very slow delinquency rate. Our delinquency rate over 90 days is less than 2%. So with this, we were able to innovate in terms of product, in terms of segments, which are typically seen as riskier, but having pretty good results in terms of the behavior of the portfolio. But then after this product, we realized that, okay, but there are still some families that are not eligible for mortgage loan, are not eligible for down payment, but they still have the capacity to pay for a rent. So that's where we decided to create the lease to own product. We created this product like 9 months ago in Chile. We started in Chile, and this product is performing super, super well. Why? Because here we are understanding that we need to mobilize the capital markets at some point. They were reluctant to lend money to these segments, but with the lease to own, we, as Credit 2 or the fund, is the owner of the house. And then after 20 years, the last installment, the client becomes the owner of this house. So we are providing access to everyone to have their place to live. Go to next one. And I think the success of this type of models is related to the capabilities and conviction of the team to really create this balance between, okay, how we can solve this access problem, but also create new types of assets which are attractive to the capital markets, to pension funds, to insurance companies. Go to next one. And well, with that, we are proud to say that we are empowering the next generations to have their houses. Here's some final thoughts on this. There are still millions of families that are good payers or can be good borrowers, but just now they do not fit the traditional models. Second, all of us we are here, we need to put ourselves ahead. We need to speed things up. We know that housing industry is not an industry that have a lot of innovation, so it depends on us. We have opportunity, we have scale. And the final thought is that we truly need to do a collaborative effort between governments and private institutions. Not only this does not only create wealth, it creates financial stability, but finally it creates or pushes the social mobility. So thank you very much.
Thank you, David. Just let me summarize what I have learned so far about Credit2. It shows how fintech can meaningfully expand access to housing finance for underserved households by using digital processes, alternative credit assessment, and innovative products such as down payment financing. It enables first-time buyers, especially women and lower-income families, to access home ownership where traditional banks fall short, while operating at scale and attracting capital market funding. With this in mind, David, let me ask you a question. In practical terms, how does fintech infrastructure reduce costs and expand access along the housing value chain?
Yeah, you have the data there available to be used. We are now using AI agents to evaluate the risks. So that reduces not only the speed, but according to our estimations, we have been able to reduce the client acquisition cost more than 80%. So when you compare how much banks are spending to capture each one of the clients versus Credit2 capturing the clients, you have a huge difference. Like they spend like 10 times more than we do. And at the end of the day, that could be translated into the customer to have a better fit, better access, and at a fair price.
Thank you, David. I know that you have to leave earlier, so thank you again for joining this webinar.
Thank you very much.
So now let me move forward to our third panelist. I hope I can pronounce correctly your name. Olayumok Akinwumi, co-founder and real estate lead at Hábitat. Olayumok will present the Eco Equity Investment Company, a blended finance initiative designed to close the gender housing gap in sub-Saharan Africa, supporting women-led business across the sustainable housing value chain. Her perspective highlights how investment strategies can simultaneously advance financial inclusion, gender equity, and climate-resilient housing solutions. Welcome, Olayumok. The floor is yours.
Thank you very much, Gabriela. And you did try to pronounce my name right. Let's just leave it at Ola, because that's a more well-known name.
Perfect.
And thank you so much to UHPH and Marina as well for the invitation. I am pleased to share with you the work that we've been doing in the past year and a little bit on housing, gender, climate, just at that intersect. I will share my presentation now. Great. As Gabriela mentioned, my name is Olajumoke. Ola for today's session. I'm co-founder of Alifia Capital. It's a Nigerian-based company. Back in the day before impact was a popular phrase, we set up the business because we were living in an environment that was important for us to do good so that we could do well. And that was our tagline. Today, we will be named called Impact Investors. We manage currently Africa's largest gender fund, a small fund, but a step in the right direction. But today, I'll be speaking to us about Eco Equity Investment Company, which is a blended finance vehicle that invests in women, building green economies, and delivering sustainable, affordable housing. All right, so what is Eco Equity Investment Company about? First of all, it's a blended finance investment platform. And the reason for being is to expand capital access across the housing construction ecosystem. I mean, ultimately, a lot of the conversations that we're having is about housing finance, the product being the delivery of homes. But I heard Sebastian say something really significant, that ground-up development is the only way to go. And as we sit in the context of Sub-Saharan Africa, we realize that focusing or addressing housing finance specifically is not enough, because there are so many issues within the ecosystem, and we have to then address that a whole lot more holistically. The other part of this is, as I mentioned, our focus is gender. There are structural, social, and cultural issues that prevent women's access to home ownership, and this facility will address some of that. The climate issues are clear. We have to not contribute to extending the pain that the earth is suffering for the fact that we are building. And finally, of course, financing that makes sense across the value chain. So through the vehicle, Eco Equity Investment Company has actually, it's a dual facility vehicle. The first part of it is what we've called an enabler facility. And just by what that means, when you hear it, it's financing the construction value chain. It's putting money behind the MSMEs, and it's specifically looking at women-owned and women-led MSMEs. Why are we doing that? The truth is that the MSMEs are the engine of production of the outputs that then lead into the construction of homes. On the home development side, this is also to support what we've called gender smart cooperatives. 80% of Nigerians are in the so-called informal sector. So what that means is they're completely excluded from any opportunities of financing from the traditional structures that exist. And so we find these people sitting in cooperatives, and the cooperative structure by nature is already being built around people. And we have seen significantly, and I'll possibly reference India as a place where the cooperative structure, the group structure, has been used to mobilize capital and to finally provide opportunities for people who have been excluded. As I said earlier, the vehicle is a blended finance structure. It's a proof of concept vehicle because nothing like this has been done, at least not in Nigeria and possibly not in Sub-Saharan Africa. And so there's a grant component. We don't romanticize the challenges that are there, and we know that there's a whole lot of hand-holding that is required to make this work. And then there's obviously concessional capital that supports risk absorption, and private capital, which would help the vehicle to scale. Right, so I've heard all kinds of data today about the challenges, the gaps, the opportunities. Sub-Saharan Africa has a special housing finance paradox, and I'm sure that Kesia will speak a little bit more about that. She spent so many years gathering data and sharing that data across the continent. The housing deficit across Sub-Saharan Africa is about just over 50 million units, we're told. Nigeria probably is carrying about a third of that, more than 15 million units. Mortgage penetration is abysmally low at about 1% of GDP. Yet, what we see is that across Sub-Saharan Africa, homes are being built. Millions of homes are being built. But the truth is, most of it incrementally, most of it informally. But this is happening year in, year out, outside of the formal structures that we know. Now, who's building these homes? We have small contractors and builders who deliver majority of the housing. And I'll use Nigeria as an example where we do not have any large-scale institutional home builders. What we have instead is perhaps hundreds of thousands of small-scale contractors. Who is providing the components for the small contractors? Again, we have small-scale construction MSMEs who produce some of the key materials and services. Another example to share is that we do not have builders merchants in Nigeria. So many of these businesses are really truly small. And who are they building for? By the way, all these actors I've named actually are completely outside of the formal financial structures and opportunities that exist. So who are they building for? They're building for many people in the informal sector, some in the formal, but many still sitting within cooperatives. And then the question is, so why this huge exclusion? And how has that impacted the ability of an entire economy who has identified what the problem is to solve the problem? The answer is simple. They're just multiple structural barriers in the financial ecosystem. And so this is what EIC sets to address. Sounds like a really big task, but we tell ourselves regularly that an elephant is huge, but if you want to eat an elephant, you start one bite at a time. That's the only way. And so what EIC does is that it addresses two pathways. On the enterprise side, it addresses the structural challenges that we have, which actually is made worse by the fact that we're also being specific about addressing the gender imbalance in that sector. And those perceptions are very clear. Just simply the fact that anything that's early stage, that's of certain size that is green, green technology is still a little bit unfamiliar to mainstream financing, is also already perceived risky. And when it's women-owned, there's enough statistics to share how those types of enterprises are often overlooked by traditional lenders. On the other pathway, which is the homeownership pathway, the access to housing through cooperatives and the savings groups, it's usually loaded with informal sector. Majority of the informal sector are women and all women-led households and small enterprise owners. So the first barrier that they suffer from is the income assessment barrier. The assumption that everybody earns a regular sum of money every month is completely, I use the term un-African, because majority are enterprises and working, in the informal sector, as I explained. So that informal sector stream is not something that banks are, I would say, in some ways, even not interested in, because the verification process is extremely difficult. And this is where technology has come to make a big change. And there are also collateral barriers, land titling and asset ownership issues, which can be quite complex. We understand that. And then there are the transaction cost barriers. I mean, why do relatively small mortgages for relatively small parties when there could be an opportunity to do much larger scale? Plus, there's obviously the additional administration layer to attend to when things are not standard. Just a couple more things to say about this. We see that capital doesn't often reach this type of businesses and this type of people because they're somehow sitting in the middle ground. The businesses are too large for informal, family and friends capital, but they're too small to be attended to by conventional lenders. And so on the side of home ownership, I mentioned what the key challenges are. Just the fact that income is not steady and is not predictable is already enough to disqualify a number of these individuals. So for us, we see the issue not merely as the need to deploy capital. We see that their risk profile plus their capital needs and their growth trajectory just simply doesn't fit our traditional credit models and systems. So this is what the blended finance intervention is. And I'm not saying that blended finance is the magic, is not going to solve all of the problems, but it certainly starts to address some of the things that traditional financing will not touch. And what do we see here? So for value chain enterprises, what would the grant capital do? Blended finance addresses these specific barriers. In terms of grant capital, it will address the capability constraints. And there's no denying that that exists. In the past year, we have been, thanks to a grant from Convergence, we have been doing quite a bit of work building up, first of all, understanding the market, and then building up our feasibility study towards demonstrating what is possible in this space. So enterprise diagnostics and business development, production efficiencies and improvements, climate, ESG compliance, these are all issues that grant capital will support. A strong technical assistance program is certainly a prerequisite to building up in preparation for investments. So we see this as the outcome of this will be just getting the enterprises investment ready. On the homeownership side, what does grant capital support? This is to support the preparation of the ecosystem. And in what ways? There's strengthening required in the cooperatives governance structures, certainly. The housing development planning also is something that is that needs to be supported, just the technical skills. I mean, I noted in the presentation that was shared by Mr. Shukla that the bank itself is responsible for an end-to-end implementation. And that is typical of the ground-up thinking, because when you understand what the challenges are, you need to build the framework and the infrastructure to support the attainment of the objective. Financial literacy is also something that we find, particularly with women and women-owned businesses, is lacking. And that's something that the grant capital will also seek to do. So at the end of the day, the cooperatives are then made ready for borrowers. On concessional capital, this is, of course, what addresses the risk perceptions that we find. And that's gives some comfort to our investors. The sensitivity that comes with concessional capital is that it enables longer repayment tenors, and we've seen that in some of the vehicles that we have been privileged to manage, and just the ability to structure some flexibility with production cycles will be important for the enterprises. The outcome of that will be that risk profiles become a little bit more acceptable to investors because they can then interpret what they're seeing a lot clearer. As far as homeownership is concerned, the concessional capital is addressing the perceptions of credit risks. It enables slightly longer term repayment tenors. We've seen that happen. There's also some flexibility introduced into the structures. It certainly absorbs some of the risks that we know are obvious for, earning the way that they earn their incomes. And the outcome for that will be, we expect lending to cooperatives will become a slightly more financially viable opportunity. And obviously, private capital helps us to scale the outcomes that we get. So this is a simple summary for us. I started by saying that the intention is ultimately to be able to deliver more affordable green housing, but it's fundamentally more about strengthening the production ecosystem on the one hand, that's the system that supports housing delivery, and also then to create a more stable demand ecosystem for the homes themselves. And so the outcome we expect will be that green components become more readily available. And for Nigeria particularly, that will mean reducing dependence on imported materials. There's a lot of statistics around that, and that's probably the same across most of Africa. At the moment, 70% of the components that make up a home is imported. So the idea of developing an ecosystem that then engenders the production of housing shouldn't then imply that we start to import a whole lot more from outside of Nigeria. The fact that this should lead us to be able to demonstrate the effects changes by providing women-led green manufacturing and demonstrating that they can be commercially viable is also important. And then obviously supporting contractors to gain access to affordable, sustainable materials that's being produced through the investment in the enterprises. So again, the intervention is not simply about financing the enterprise, it's about making the enterprises strengthening their capacity to produce so that for the benefit of the homes to be produced. On the other hand, for investors, I think one of the critical things that we see is scaling green manufacturing enterprises would mean that there is obviously diversified investment opportunities. And I know that investors like the stories around strong job creation and measurable climate impacts. So for us, when financing becomes accessible, the cooperative members also become homeowners rather than renters. And I admit that not everybody wants to own a home, but even building a rental portfolio for that demographic also becomes possible. Even the so-called informality around what currently are the current practices become a little bit more formalized and therefore more bankable. And construction pipelines also become a whole lot more predictable. For investors, the cooperative housing model, which is not a new model, is existed for a long time. It provides a diversified housing demand, just another demographic to look at in terms of what is potentially investable. It obviously lowers the default risk because of group accountability. There's a lot of stories and a lot of data around how that has worked in other sectors, and it can certainly work in the housing sector as well. I mentioned already the predictability of the development pipelines. And more importantly, just this inclusive home ownership markets are then developed. The scalable social impact outcomes that are important for many impact investors. So blended finance, we see that as unlocking both the production side, but also the ownership side of the housing ecosystem. And our attempt at working this is, as I mentioned, bidirectional or dual directional, because it's impossible to address the demand side without dealing with the issues that we have in the supply chain side. I thank you very much for the opportunity to share our story. We are currently in the middle of the race for a $20 million proof of concept vehicle. We have a credible pipeline of women-led, women-owned green producers, enterprises in the value chain. We have a pipeline of cooperatives with pre-qualified beneficiaries, majority women who are aspiring homeowners. And to us, this is an exciting opportunity to make this happen. Thank you very much, Gabriela, and to everyone listening. I'll take questions.
Ola. Thank you very much, Ola. Important to highlight the work that Alicia is expanding access to housing by mobilizing blended, gender-lens capital across the housing value chain. Through this type of vehicles like its climate and gender-responsive housing fund, without doubt, it unlocks finance for affordable, sustainable housing developers while ensuring women are included as homeowners, entrepreneurs, and beneficiaries, showing that inclusive housing finance in Africa can be both investable and scalable. Ola, I would like to ask you two questions. The first one is, what design features can make the equity investment company an effective blended finance vehicle for closing the gender housing gap?
Thanks, Gabriela. So we've kind of looked at four things. The first is just the fact that the investment vehicle itself is a dual facility structure. That in itself means the simultaneous stimulation of the two sides of the gender housing gap, because there is a gap in enterprise support and there is a gap in home ownership. So this means that we're stimulating women's economic participation in the housing value chain at the same time as we're stimulating women's access to home ownership. The second point will be just the blended capital stack. Used the right way, we understand what technical assistance can do. Technical assistance strengthens enterprise readiness. And many women, and we've done a whole lot of raft of interviews of women enterprises. One of the things that they say when they approach traditional financing institutions is they often hear the feedback, "You're not ready." And so there is highly likely some truth to that, but there's a fair amount of work that one can do to strengthen enterprise readiness. But it's not just the enterprises, it's also to strengthen cooperative governance, financial management, climate resilient construction through the builders that are being engaged to do the work. So addressing these capability gaps that typically prevent women from being the lead actors in the ecosystem is something that clearly would help. Second thing is the risk partitioning we've done to the vehicle. So the vehicle structure is a variable capital company, and that means that investors are able to allocate capital to whether the enabler facility or to the home development facility, or both. And that in itself really engenders allocations, to different risk appetites, while we still maintain the unified, gendered, and green impact strategy. We see that as something that is attractive to investors, and that should encourage the willingness to participate in this. And finally, just the gender intentional investment strategy that or criteria that we have created. So all investments are screened using gender lens metrics. We were contributors to the 2X, and so that is our base. And we have then nuanced that, because that's also important. So we have nuanced that to our circumstances. And so using gender lens metrics for ownership, for leadership, for workforce participation, for the numbers of women to be served, and ensuring that the capital flows are actually directed to actors who close the gender housing gap. So that's really making sure that the throughput ends exactly where it is that we wish for it to end.
Thank you. Thank you, Ola. I have a quick question that has been already posted in the Q&A. So let me read it for you. It says, how critical is the role of organized groups, unions, education, health, civil service, etc., in guaranteeing market, and what are the experience risk depending on them? I realize various presentations did not mention them as stakeholders.
So, I mean, they are an absolutely important stakeholder, especially in an environment where, as I said, the majority are in the so-called informal sector. So for us, they have been one of our three pillars. The enterprises have been one, that group, which are typically arranged around all kinds of associations and cooperatives are the second. And then the builders themselves are the third. So for this, many of the cooperatives and unions that we have engaged have been in existence for decades. And outside of housing and this particular sector, they have stood as guarantees for all kinds of other interventions on behalf of their membership. And if those, I know that housing has a slightly different bent, it's long-term, it is reasonably large size capital. But what we see with this is that they are perhaps the best model for providing a guarantee on behalf of their membership. Now, we're currently working through designing a framework alongside them as to how to institutionalize these kinds of guarantee frameworks. And this is one of the first things that we'll be testing. But you know what the outcome of that is? It has also then brought government and policy developers to the table. And that's, one of the things that happens when you develop a program ground up. And I don't know if I've quite answered the question, but that's how far we have gone. Thank you.
Thank you. Thank you, Ola. And again, we really appreciate your presentation. So we have to move forward. Thank you again to our panelists for those valuable insights. We noticed that there is a question for David in the Q&A. So we will share this question with David, and we will answer directly via email to the panel, to the participants. So to close our discussion, we will now turn to one case study that illustrates how housing finance ecosystems operate in practice. Our case study brings a perspective from across African housing finance markets, where many of the most interesting innovations are still emerging. We are pleased to welcome Keisha Rust, Executive Director of the Center for Affordable Housing Finance in Africa, a leading research and knowledge institution dedicated to improving housing finance systems across the continent. Through her work, Keisha and her team track housing finance market across multiple African countries, helping shed light on how new data, fintech tools, and alternative credit approaches are beginning to open pathways to finance for households traditionally excluded from formal systems. In this session, she will share early signals from the market, small but important innovations from housing microfinance to new underwriting approaches that point the wider opportunities for expanding housing finance accessibility in the future. Keisha, we are delighted to have you with us today, and the floor is yours.
Good afternoon, maybe good morning for some of you as well. I've lost track of the time. It is such an honor to be with you here today. Thank you. The presentations and the discussion has been great, and it is so nice to have the opportunity to get such a global perspective. So congratulations to all of you who've put this together. I'm going to share my screen. Here we go. Oops. Continue to share. Can you see my screen? Gabriela, can you see it?
There is a message there. It's not clear, the image that we see.
There we go. It's gone away now.
Yes.
Hey? Is it better now?
Now it works. Yeah.
Excellent. Thank you so much. Okay. How can we expand financial accessibility? So there have been so many good examples already of what's being done. And I think the bottom line that's coming from this is that the reason we need to expand financial accessibility is that there are people and companies and institutions that are excluded from the financial system as it currently exists. There have been different reasons projected for why that's the case. And of course, it's different in different contexts. So I thought I would give a quick overview of the African context to augment a little bit of what Jumoke said. And then share 3 different companies that are doing some interesting work. So my examples are going to be shorter than the ones you've heard already, but they can be further explored, I hope, by colleagues if you're interested. So how do we expand access to finance? Well, let's first start with what we see and really pay attention to what that is. This is research that we did a couple years ago in Rwanda, where we found that 97% of urban households and 99% of all households live in housing that wasn't built by a developer. Now, Jumoke has just said that, and the other colleague, the fintech model, also had said that is what is happening, especially in places where the market isn't fully working, where you've got grossly unequal societies where you've got a very high income minority for whom the development sector builds, and then you've got a very large informal sector or low income population. But what we found here, and this was we took data from the income and expenditure survey, and which was done by the statistical services within Rwanda. And we looked at the question that people answered, what kind of house do you live in? And we segmented the population by the kind of house they live in. And we added these photographs based on our own understanding of what that house looks like. So the survey definition is there right below the photograph, and then the number of households that are in each of those houses. So in terms of let's look at the very bottom row, the percent of urban households. 9% live in the rural peri-urban incremental mud house. 72% are living in some form of backyard landlordism, where they're living in a unit that is on the property of somebody else that has been built with formal materials, but is otherwise looks informal and looks inadequate. Another 17 are in a little bit more formal, also backyard rental. Employee housing is less than 0.5%. And then developers, small-scale developers and large-scale developers are about 2%. They've delivered 2% of the housing that is being occupied by people. That must make us think that even if we double the delivery of formally built housing, we'll then have 4% people living in it. If we quadruple it, we'll have less than 10% of people living in that. So we have to understand that the way in which housing is delivered for the majority of the population is not via developers right now, in this current period that we're in. In Kenya, we found something very similar. This is data that's taken from the census in 2019 in Kenya. And here we looked just at rental households. And we found that only 17% of urban renters were served by formal developers. And again, I imagined that if somebody is renting, they're paying on a monthly basis for their accommodation. There must be a level of formality in that accommodation, and yet that's not so. So there are people who are living in very informal conditions, and yet there's a financial transaction that is happening between the tenant and the landlord. So we need to understand that and understand the market that these landlords are serving. Looking again at Kenya, and this is an analysis done by a colleague who scoped out, it looks a little complicated, but it's the income pyramid. So if we look here at the blue, the green, and the orange, that's ultimately the number of households per income group. The income group goes up the axis. That's the number of households per income group living in Kenya. In Nairobi. This is Nairobi figures. And then the second column, this column here, are the average unit prices of 9 projects that were delivered by the state subsidized housing program. The cheapest one sits about here, which is above the bulk of the population that's living there. And this is delivered by the state. And then we've got the loan affordability on the far right-hand side. But that whole segment, the belly of the population, is not able to access housing, even that the state is delivering with very high levels of subsidization. We have to bear that in mind when we think about access to finance. And this has been said by others. It's just a different way of looking at it. We need to hold this, though. Okay. Meanwhile, there are some really interesting things that are happening on the ground. And this is a set of these 5 images are of the same piece of land in Nairobi. And if you look at the image, you can see consistently this development here. Here it is. This was developed by the Kenya Power pipeline company. This area is called Pipeline. And it was a development that was built for the workers of the Kenya Pipeline Company. And in 2009, Google Earth showed a lovely vacant plot across the street. And by 2011, you can start to see some development. By 2012, look at that, the buildings have grown quite high already. By 2013, you can see that they're filling in other places. And by 2024, it's packed full. These are 8-story walk-ups. They're tenement buildings that have been built by developers who have, in fact, legitimate businesses elsewhere, but they're building these informally under the radar of the government. The government says that the country in Kenya, all delivery in Kenya is about 50,000 residential units per annum. And yet we found, if you look at the census between 2009 and 2019, there are 158,000 new urban renter households every year. That's 1.6 million over the 10-year period. And 89% of those rent from private individuals. So let's think very carefully about who is it our target market we're supposed to be financing. What's fascinating is that while the government and while the DFIs haven't seen this and engaged with it, some of the banks have. Now, they're not lending mortgages on these properties. In some cases, they're mortgaging other properties to put money in here. But ultimately, they're lending not against title, but for cash flow, because they know that these will pay back in a very short amount of time. And it's an excellent business because it's building and building and building all the time. We need to watch this to see where the finance is and how it's getting to the particular market. We did other work in Rwanda where we saw, here we are, we looked at households who were earning less than $180 a month. And this is a stylized image of an aerial view of someone's property. This is someone who had legal rights. They had not a title deed, but they had a residence permit to live on this property as one family. Well, the family, I think, has 5 people in it. The whole plot right now is housing 25 residences. Plus, it has a number of businesses as well, and it's squeezed together. You can see that in the middle here, there is the section where the communal space where people come together. There's a huge problem here with water and sanitation that needs to be addressed. But the income of the household who lives here, who delivered all of this housing, 70% of that monthly income comes from the rental income that they're getting. So it's an income stream that's coming in that should be able to enable them to improve the quality of the stock that they're developing if we think quite creatively about how we offer finance. Another example here, so this is Zambia. 46% of urban dwellings in Zambia are estimated to be self-built. We did, every year, CAF collects data on the price of the cheapest newly built house, on the terms relating to mortgages that are available, and then on what a teacher or other basic low-income workers might be earning, low middle-income workers are earning. So this was in 2022, this data here. And if you are a law enforcement officer living in an urban area in Lusaka, you earn about 3,660 kwacha per month, which means you can afford a house with a mortgage that would be 85,000 kwacha. And yet, even on the resale market in Lusaka, here you can see on the right-hand side, these are the prices for fairly modest entry-level middle-class houses. Police officer would consider themselves to be at the entry level of the middle class. Similarly, so a teacher who could afford 101,000 kwacha house And yet the houses that are available in Lusaka are not even a little bit, they're entirely out of reach. So we move on and we take a look also, and this is something that others have said in Uganda, and this exists across the continent. When we take a look at what households earn and how they earn their money on the offtake side, the way in which urban residents in African cities are earning their incomes does not match what a lender can finance. They're either, if they earn from the private sector, the majority in the private sector are informal earners. If otherwise their households employed, only a very small number are employed by the public sector, which is formal, and that becomes the target of most policies. So housing capital needs to meet the borrowers where they are. And the consumers of housing have a range of issues that are constraining, that undermine their ability to access finance. But their housing needs are changing over time. And there's a lot that's happening with urbanization. So there's a demand that's there that's latent, and there's an opportunity for that to be financed. The suppliers of housing, they don't look at all like someone that a lender would finance. But they're experts at targeting the market and delivering a product that people can actually afford, even if they can't get to scale. And their scale is achieved through hundreds of suppliers, each delivering a few, rather than hundreds of houses being delivered by one or two. So pulling that together, the key financial challenge is the aggregation of demand and the disaggregation of the supply of finance so that they can meet one another. And there's 3 companies I want to quickly talk about that address this. The one is Tough in South Africa. Bitprop is also in South Africa. And then Empower, which is, I think, across Africa, but with a good track record in Mozambique. So Tough is a commercial mortgage lender, and they provide mortgages to people who build rental accommodation or who refurbish inner city rental or who renovate, and on a sectional title or condominium basis. So it's an entrepreneur who has maybe 3, 5, maybe 20 units. And through the course of that, you can see over the 22 years that they've been in operation, they financed almost 67,000 units in 712 buildings with 587 borrowers. These borrowers are new entrepreneurs. They used to be part of the demand side, but through this, they've been able to become part of the supply side. One problem that they face is that those borrowers, 68% of whom are people who've never operated as business people in this way before, they don't have equity. And so they can't participate in a development process where equity is demanded. So what Tough has established is something called the Intertuko Equity Fund. And if we take a look at this blended finance structure here, Tough provides the loan, which is property finance, commercial mortgage finance, repayable over 15 years. And that's 80% of the capital required. They would love to have a 20% deposit, but the developer can't offer that. So they require that developer, who is the borrower in this case, to provide 5% equity. And then the Intertuko Equity Fund, which receives capital from social impact investors, is able to provide a loan that performs as equity in the mezzanine part of the stack. So that's a very interesting way in which they're able to leverage the interest of small scale, formerly informal entrepreneurs to deliver housing. I'm going to move on to Bitprop. Bitprop is a really interesting company because they've looked at the incidents of that I showed in Rwanda, where people are building units in their backyards. But the problem, as we've seen in Rwanda and also in South Africa, is oftentimes the quality isn't very good for that backyard construction because there isn't any finance to do it quickly. So what BitProp does is, on the basis of the fact that the homeowner owns the land, so in South Africa, that's the case, the homeowner owns the land. BitProp finds a local contractor to build flats to a quality that their investors are happy to finance. And then they support that landlord in managing their rental business to the point where they're able to repay the loan. And then they have a group of tenants living in their backyard, which over time becomes a long-term investment and savings instrument, and quite critical in the context of very high unemployment, where you've got employment happening. The third example I want to give is Empower, and Glenn Jordan is in the room. And so Glenn, if there's anything you want to put into the chat, I suppose you could. But what I find so interesting about Empower is that they are capturing the commitment. Everyone in this webinar has said that people pay, but an investor says, yeah, right, prove it to me. Well, Empower is able to prove it because they capture that end user commitment, the regular payments, in a way that the investor can see and that the developer can then act upon. And so what they do is they use blockchain technology to be able to track and manage the rental process, the build process, and the repayment process. And they intervene so that Empower engages with the capital providers, receives the capital, is able to give the loan to the developer. The developer then provides capital to his or her buyers on an installment sale or rent to buy process. And they're managing. Now, if that developer fails, Empower has another one that can come in to capture the pipeline of people who are saving and paying their rentals on an ongoing basis. So it's a wonderful model. I can't describe it in enough detail right now because of the time. So that's worth looking at. Now, lastly, housing capital needs proof. And there won't be any investment coming in if there isn't data. And yet all of these initiatives, they're exhausted just running their businesses. Capturing the data is a really difficult thing to do. Empower has done it more automatically in the way in which they're managing the business. So that's definitely a way to go forward. But additionally, we need to think much more carefully about how to collect and then share in an open way the data that normalizes all of these examples as being the way everyone does it. So we've developed, CAF has developed something called the Open Access Initiative together with our partners. And we've started it in Kenya, where in this diagram, the first two circles, the blue and the outside black one and then the white one, that data is easy. We've been collecting that for years. What really matters is fund data and project level data to show where the risks are so that investors, once they can quantify their risks, then they can price for them and then they can manage them. And then the capital will flow. So my last plea to say to all of you is, please, if you can bring together all of these examples that you've shared, we need a mechanism now where they can all share their data from their experience on an ongoing basis going forward. I would love to speak to whoever was interested in this about ways in which we can align our definitions and make sure that everyone's collecting data that can then be comparable. I'll stop there. I'd like you all to join us at the AUHF conference, which is taking place in Lusaka, Zambia. That's the African Union for Housing Finance. It's a great place to come if you want to learn about the African market. Chumoke is a member, Empower is a member, TUF is a member. So we'd really love to see you there later this year. Thank you so much.
Thank you very much, Keisha. Just to highlight that it has been a wonderful presentation, very insightful. It's very interesting to see how CAF has supported affordable housing in Africa by providing data, market intelligence, and policy analysis to make housing finance markets work better. Thank you again, Keisha. As we conclude today's session, I would like to thank you, everyone, for participating in this interesting dialogue, especially thank our keynote speaker, our panelists, and all participants for contributing to such a thoughtful and forward-looking discussion. Today's conversation reinforces an important message. Expanding access to housing ultimately requires expanding access to capital. Financial innovation, whether through fintech platforms, blended finance structures, or impact investment, offers powerful opportunities to mobilize resources and reach underserved populations. However, innovation alone is not enough. Its transformative potential depends on the ability of institutions, regulators, and financial actors to ensure that these new financial architectures remain aligned with long-term affordability, financial stability, and social impact. Thank you again for joining us today. We look forward to continuing this dialogue in the Housing 2.0 series, and we hope to see you in our upcoming sessions. Have a wonderful day.